assets equals liabilities plus owner's equity. I'm now going to explain the difference between permanent accounts and temporary accounts. Accounts used to accumulate information from one fiscal period to the next are called permanent accounts. Permanent accounts include the asset and liability accounts and the owner's capital account. Temporary accounts are accounts include the revenue, expense, and owner's drawing accounts, plus the income summary account. Temporary accounts show changes in the owner's capital for a single fiscal period. Therefore, at the end of a fiscal period, the balances of temporary accounts are summarized and transferred to the owner's capital account, which is a permanent account.
We're going to start with closing the revenue account. So since there's 16 M&Ms, we're going to go ahead and credit it. And then in order to close it, we have to debit it. So put the 16 over here, and since it's debited, we have to credit an income summary. And then to close it out, it would be 0, and then we take this, and since it's credited, we put it in the credit income summary cup, and then turn it over. Next, we're doing the advertising expenses. Since there's 3 expenses, we're going to close them all at the same time. There are 3 in the advertising, 6 in the rent expense, and then 5 in the supplies expense, and they're all debited because they're expenses. So we can go ahead and start with the advertising expense, close it out, credit it since it's a debit, and then close the rent expense out, and then close the supplies expense out. And then since those were all credited to close out, we will debit all the expenses, 14 totaling them all up, and then we will go ahead and put the supplies expense in the debit cup along with the rent expense and the advertising expense. And then we can go ahead and close out those accounts.
The accounting equation is assets equals liabilities plus owner's equity, and all of these accounts are permanent accounts.
In an income summary, there are 2 categories. There's revenue and expenses. If there's more revenue than expenses, it would be a net income. If there are more expenses than revenue, then it would be a net loss.
So you counted up all your revenues, and for your first transaction, you put a 9 on the debit side, so it makes it 0 on your revenue. And then make it even out, you put it on your credit side and put a 9. And yeah.
Okay. Now
for your revenue, you put it in your income summary credit side, so all your revenue is gone. And for your rent, you credit 4 and to make it 0, and you do the same for supplies and the advertising expense. And when you credit all those, you put it on the debit side of the income summary. 6, 10, and then gather up all your and then they're all gone, and they all equal 0.
Okay, so our expenses is 10, and our revenue is 9, so we had a net loss. So you put the 1 here, and then you would have to credit this side 1, so it would cancel out. And then to have another debit on, to even this out, you need to debit over here. Okay. To show that I had that loss, I would have to take one out of my capital cup and put it into...
Just get rid of it.
Okay, never mind, we're just getting rid of it. Then your fourth adjusting entry would be in drawing. And it would be 2. So that would be 0 again. So see, capital's the only one with anything left, so it would be my permanent account. All the other ones have been canceled out, so there's nothing left in them. Okay, so we credited this side and we had to debit this side. So to show that, I'll take 2 out of the capital because there was a withdrawal.
Therefore, at the end of a fiscal period, the balance of a temporary accounts are summarized and transferred to owner's capital account.
So what we're going to do here is we're going to close out our accounts here. So let's just get right on it. So our first action is to close out our revenue account. So since it's our first correcting entry or adjusting entry, put a 1 in parentheses. And then since we have 17 in the credit side over here, we're going to debit to close out this account. Debit 17 there, and that's close out there. But so since we debited 17 over here, we have to put 17 into the credit side of the income summary. So we do that. So now we're going to come over to our M&Ms here, and we find our revenue, which is this, with 17 blue M&Ms in it, and we're going to close it out to the income summary credit side, which would be this one. So we throw that in there, and this one's closed out. So now we're going to come over back here, and we're going to handle the expenses. So since this is our second adjusting entry, in order to offset the 7 debit, we put 7 credit over here. So there's 7. And what I'm going to do all 3 expenses, and then I'm going to add them up. So we have 7 there, and then we have 10 here. Continue with the 2 since it's the same. So we have 17 right now, and then come over here and get 8. Close that out. So we have a total of 25 expenses. So, and since we credited all these, we have to come over to the debit side of the income summary and put in 25, which is our second adjusting entry. So 25. So now we're going to come over back to our cups here, and we're going to get our rent expenses into our debit side. That's closed out. We're going to get our advertising expenses in. That's closed out. And we're going to get our supplies expense. And that's closed out. So now we have 25 in our income summary debit. And now we're going to find the balance here. So our balance is our revenue was 17 and our expenses was 25. So right now we have a net loss of 8. So our loss is 8 so far. So now I'm going to turn it over to AJ to show you how to close out drawing and transfer it to capital.
All you do is you take 17 out of the income summary credit side. So take 17 out of here. And you should have 8 left. And then you want to close out this 8, so you put 8 on the credit side. And you have to debit it on the capital. Debit it. 3, 8, 9. So you take out 8 out of here. I suck at camera. So this is 8. So here. You deduct it from the credit side and go 6 over on the credit side. And then you want to close out drawing, so you put 4 on the credit side, and then 4 over here, because you have to do it on the debit side and the capital. And then take 4 out of here. And as you can see, there's 2 left over. Deduct that from the credit side, and you left 2.